22% of German manufacturers are planning to relocate production to Poland within the next 12 months, not considering planning. And 56% intend to make the move within 5 years. This isn't speculation, this is German industry voting with its feet, abandoning the continent's traditional powerhouse for its eastern neighbor. While headlines obsess over tariffs and tech giants, a seismic industrial migration is reshaping Europe's economic map. Poland isn't just attracting investments anymore. Polish companies made a record 9 acquisitions in Germany last year alone. Think about that. The junior partner is buying pieces of the senior. Germany built its reputation on engineering excellence and manufacturing dominance. That foundation is cracking, and the data reveals something mainstream coverage won't touch. This shift is accelerating, not slowing. Factory by factory, sector by sector, Poland is becoming Central Europe's industrial anchor, while Germany confronts costs it can no longer justify. We're going deep on the companies leading this exodus, the cost disparities driving it, and the question no one's asking out loud: is Germany's industrial base itself at risk? The numbers landed in February 2026. 56% of German companies now plan investments in Poland. But here's what matters. 41% are moving within 12 months, and 19% of those investments exceed 5 million euros each. These aren't exploratory pilot projects. They're capital commitments that signal fundamental strategic realignments. Survey data from the German Eastern Business Association confirms 51% of German firms choosing relocation pick Poland as their destination. Not the Czech Republic, not Hungary, Poland. The reasons? 37% cite skilled labor availability. 33% point to low labor costs. 40% identify high market demand. This combination, talent, affordability, and customers, creates gravitational pull that Germany's legacy advantages can't counter. December 2025 industrial production figures tell the other side of this story. Poland posted 7.3% growth, 7.3%. Germany managed well. Germany's numbers don't inspire confidence. Poland's GDP is expanding at nearly 5% annually, positioning it as one of the EU's fastest-growing economies. This isn't cyclical bounce. It's sustained momentum fueled by foreign direct investment, EU structural funds, and aggressive industrial policy. But the real shock came from acquisition data. 9 Polish firms bought German businesses in 2205, record high. The traditional flow German capital acquiring Polish assets has reversed. The economic hierarchy that defined post-Cold War Europe is being rewritten, transaction by transaction. This matters because Poland now operates 2,081 business service centers, employing 490,000 people. That sector alone contributes 5.7% to national GDP. Its sophisticated infrastructure, supporting manufacturing, logistics, and R&D operations, the exact ecosystem German firms need when they relocate. And they are relocating. The survey revealing 22% planning moves within 1 year wasn't anonymous speculation. These are boardroom decisions already in motion. Mercedes-Benz launched a modern business services center in Poland between 2204 and early 2205. Not a token presence, a full operational hub leveraging Poland's expanding business services ecosystem. The company that symbolizes German automotive engineering, building capability in Warsaw, not Munich. Scania followed the same path during the same period. The truck manufacturer opened new services center operations as part of 61 total centers launched across Poland in that window. These aren't back-office functions being offshored. They're strategic operations tied directly to production and customer service networks. TRUMPF Huettinger, a leader in high-tech manufacturing, established its Polish center around the same time frame. The company specializes in advanced industrial technology, precisely the sector Germany claims as its competitive moat. Yet even high-value manufacturing is finding Poland's combination of skilled engineers and lower costs irresistible. Here's what connects these moves. Each company tapped into Poland's demonstrated strength in technical talent. The survey data showing 37% of firms cite skilled labor isn't abstract. It's Mercedes engineers, Scania technicians, TRUMPF specialists. Poland graduated 380,000 university students in 2003. Many in STEM fields, many multilingual, many willing to work for 60% of German wages while delivering comparable, sometimes superior productivity. Labor cost advantage matters, but it's not the whole story. These companies also chose Poland because of market access. 30% of Polish exports flow to Germany. Supply chains already connect the two economies. Relocating to Poland doesn't mean abandoning German customers or suppliers. It means repositioning within an integrated production network while slashing operational costs. The pattern repeats across sectors: automotive, electronics, chemicals, advanced manufacturing. The German Chamber of Commerce surveys confirmed this isn't isolated to struggling legacy industries. It's competitive, profitable firms making calculated decisions to protect margins and maintain growth trajectories. 22% planning relocation within 12 months translates to hundreds of facilities, thousands of jobs, billions in capital investment. This is economic geography being redrawn in real time. 7.3% industrial production growth in December 2025. Let that settle. While Western Europe debates stagnation, Poland is expanding manufacturing output at rates typically seen in emerging Asian markets. This isn't catch-up growth from a low base. Poland's economy is nearly $1 trillion. This is genuine industrial acceleration. The business services sector provides the foundation. 490,000 jobs in specialized centers serving finance, tech, logistics, and manufacturing clients globally. 5.7% of GDP from a sector that barely existed 2 decades ago. The 61 new centers opened in 2024 through early 2025 weren't just German companies. They included Dutch, American, and British firms, all recognizing Poland's operational advantages. But here's the turn that challenges conventional wisdom. Polish companies aren't just receiving investment anymore, they're deploying capital across borders. 9 acquisitions in Germany during 2025 marked a record high. Polish firms buying German businesses, the dynamic that defined the 1990s and 2000s, Western capital acquiring Eastern assets, has reversed. These weren't distressed purchases of failing operations. Polish companies acquired profitable German firms to gain technology, market access, and Western European footholds. The acquisitions signal confidence. Polish management believes they can run German operations more efficiently than German owners, and balance sheets increasingly support that confidence. Germany remains Poland's largest export market at 30%. The symbiotic relationship continues, but the balance of power within that relationship is shifting. Poland exports finished goods, not just components. Polish brands compete in German markets. Polish capital seeks German targets. Vice President Jerzy Kwiecinski of the Polish Chamber of Commerce stated it plainly in a February 2026 interview. Poland's economy will be fueled by EU funds and Germany's own recovery. 30% of exports going to Germany means Polish growth tracks German demand. But Poland's diversification is accelerating. The dependency that once defined the relationship is gradually loosening. The trajectory points toward Poland approaching G20 status within the decade. GDP growth, industrial expansion, sophisticated service sectors, foreign investment inflows, reverse acquisitions, every metric reinforces upward momentum that few Western analysts predicted even 5 years ago. Polish investment support programs delivered direct financial incentives, tax breaks for qualifying investments, grants for job creation in designated regions, special economic zones offering years of reduced corporate tax rates. These aren't marginal benefits. They're substantial cost reductions that directly impact profitability calculations for relocating firms. The Polish Investment and Trade Agency provides more than money. It offers bureaucratic navigation, advisory services, site selection assistance, regulatory guidance. For German executives accustomed to complex, multi-layered approval processes at home, Poland's streamlined investment facilitation becomes a competitive advantage independent of costs. Labor markets tell the critical story. 33% of German firms cite low labor costs, but it's the 37% emphasizing skilled labor availability that reveals Poland's real edge. Polish workers aren't just cheaper. They're productive, educated, and increasingly experienced in advanced manufacturing and technical services. Productivity growth in Poland is outpacing wage growth, the exact combination that attracts industrial investment. Energy costs matter, though specific comparative data per kilowatt-hour wasn't captured in available research. What's clear is German industrial electricity prices remain among Europe's highest, while Poland's energy mix and lower regulatory burden create meaningful cost advantages. For energy-intensive manufacturing, chemicals, metals, automotive, these differentials compound into millions annually. Market demand drives 40% of investment decisions. Poland's 40 million consumers represent purchasing power. Its Central European location provides access to Germany, Czech Republic, Slovakia, and beyond. Logistics infrastructure, highways, rail connections, ports has improved dramatically through EU funding. The nearshore advantage means German firms can serve Western European markets from Polish facilities without the complexity of true offshoring to Asia. Think of it as moving operations from Manhattan to New Jersey. The market is right there. Supply chains remain intact, but rent, labor, and operational costs drop by 30 to 50%. Polish strategy isn't just competing on price. It's offering complete operational ecosystems that combine costs, talent, infrastructure, and market access into packages German locations can no longer match. The mechanism is simple. German CFOs run spreadsheets. Polish locations deliver 20 to 30% cost savings while maintaining quality and market proximity. That's not a marginal improvement, it's transformation of competitive positioning. Is Germany losing its entire industrial base to Poland? The question demands honest assessment, not headline simplification. The answer is no, but the reality is more complex than comfortable. German industry isn't collapsing, it's restructuring. The firms moving to Poland aren't failing companies fleeing crisis. They're successful operations optimizing costs and positioning for sustained competitiveness. This is rational capital allocation, not industrial death spiral. Polish success and German stability can coexist because they're increasingly integrated rather than competitive. The stealing factories framing misses the deeper dynamic. Poland isn't raiding German plants in hostile takeovers. German companies are voluntarily relocating production while often maintaining German headquarters, R&D centers, and strategic functions. It's unbundling, separating high-cost knowledge work that stays in Germany from production and services that migrate to lower-cost Poland. Polish acquisitions in Germany similarly aren't predatory. They're Polish firms buying capabilities they need to compete globally. Technology transfer now flows both directions. The old hierarchy, German innovation, Polish assembly, no longer captures reality. Polish firms innovate. German firms assemble in Poland. The relationship is maturing beyond simple core periphery models. Short-term trajectory through 22/7, expect steady migration as 41% of planned investments materialize. New center openings will continue. Employment in Poland's business services and manufacturing will grow. German operations will shrink selectively. Medium-term through 2030, 56% planning relocation within 5 years suggests significant industrial rebalancing. EU structural funds will keep flowing to Poland. German recovery may slow outflows but won't reverse them. Cost advantages persist. Long-term, beyond 2030, Poland approaches G20 status if momentum holds. But Chinese competition intensifies. 16% of German firms already report Chinese pressure in Poland. The Polish advantage isn't permanent, it's temporal, a window created by Germany's cost structure and Poland's convergence. That window may last a decade, maybe 2. Germany's industrial base won't disappear. It will concentrate in higher value segments where costs matter less than expertise. Poland becomes Europe's manufacturing and services hub for volume production, symbiotic specialization, not zero-sum displacement. The real question isn't whether Germany loses everything, it's whether Germany accepts this new reality and adapts, or fights economic gravity until the transition becomes crisis rather than evolution. Poland's rise isn't theft, it's earned through strategy, investment, and execution. Germany's response will determine whether this becomes partnership or rivalry. Subscribe to Economics Edge for data-driven analysis on the economic power shifts reshaping Europe, while mainstream coverage looks elsewhere.